Welcome to G Fun Facts Online. Today, we're diving into a topic that's sending massive ripples across the global economy in 2025. The ongoing international tariff agreements, particularly the high-stakes dance between the United States and China. It's a complex web, but we're here to untangle it for you. The first half of 2025 was characterized by a flurry of tariff hikes and retaliatory measures. Think of it like a heavyweight boxing match, but with economies. But then, in May 2025, something shifted. After discussions in Geneva, Switzerland, a significant development. The US and China agreed to a temporary 90-day reduction in some of the recently imposed tariffs. A ceasefire, if you will. So what did this truce entail? The US agreed to lower its tariffs on Chinese imports from a staggering high of 145% down to 30%. Now, this 30% isn't just a random number. It includes a baseline 10% reciprocal tariff, kind of a you tax us, we tax you deal, and an additional 20% tariff related to serious concerns over fentanyl precursor chemicals. It's important to note, though, that tariffs imposed during previous administrations, those known as Section 301 and Section 232 tariffs, are still in place. So it's a partial rollback, not a full reset. China, in response, reduced its tariffs on U.S. goods from 125% down to 10%. Beyond just tariffs, China also agreed to suspend or remove non-tariff countermeasures. These are things like export restrictions, and notably, this included restrictions on rare earth minerals, crucial components in a lot of modern tech. This particular measure had been in place since April 2, 2025. Both nations have committed to further negotiations. This 90-day pause is designed to create a window for these critical discussions. But there's a catch. If a more permanent agreement isn't reached within this time frame, those reciprocal tariffs could snap back to higher levels. For instance, the US had announced a 34% reciprocal tariff on China back in April, so the pressure is on. Now let's talk about the economic impacts. Even with this recent de-escalation, the tariff escalations throughout early 2025 have already left their mark and are projected to continue doing so. Direct trade between the US and China took a nosedive. Under the highest tariff scenarios, US imports from China could have fallen by as much as 90%. That's a massive drop. Even with the May agreement, bilateral trade volumes are expected to stay significantly lower than before this whole tariff war began. What does this mean for everyday people and businesses? Well, tariffs are essentially taxes on imported goods. This leads to higher prices for consumers, you and me, and increased input costs for businesses. The average effective tariff rate, or AETR, for US imports jumped significantly in 2025. To put it in perspective, it went from around 2.2% in 2024 to as high as 17.8% even after the May agreement. That's the highest since the 1930s. This translates to increased costs for American households, estimated to be thousands of dollars annually per household. And that's before even accounting for people changing what they buy to avoid the higher prices. Businesses are scrambling to rethink their supply chains. While some production might shift back domestically, a significant portion is being redirected to other countries to avoid these tariffs. This reshuffling leads to a global trade system that's less efficient and, frankly, more opaque. Southeast Asian economies like Vietnam, Indonesia, and Malaysia are finding themselves heavily affected by these shifts, sometimes for better, sometimes for worse. Certain sectors are feeling the heat more than others. U.S. manufacturing, especially industries with strong exposure to imports from China and North America, think automotive and metal-intensive industries, has been significantly impacted. Sectors like transport equipment and electrical equipment and electronics faced substantial contractions under the high tariff scenarios. U.S. agricultural products have also been a prime target for retaliatory tariffs from China. And if you've noticed higher prices for shoes and apparel, well, tariffs are a big reason why. The automotive sector, in particular, has been subject to specific tariff measures, impacting trade flows and costs across the board. Economists are projecting a negative impact on GDP growth for both the US and China. We're talking about a potential reduction in US real GDP growth of about 0.7 percentage points from all the 2025 tariffs, even after the May deal. This could mean a smaller U.S. economy in the long run. China's GDP growth is also expected to take a hit due to reduced exports to the U.S. The labor market isn't immune either. These tariffs are projected to have a negative impact on employment in the U.S., with potential job losses numbering in the hundreds of thousands. And, of course, higher tariffs contribute to inflationary pressures, which can dampen consumer demand and slow overall economic growth. The uncertainty surrounding all these tariff policies has led to increased financial market volatility, a roller coaster ride for investors. And this isn't just a US-China issue. The trade tensions between the world's two largest economies contribute to a broader slowdown in global trade and economic growth. International organizations have had to revise down their global growth forecasts, citing these tariffs as a key factor. Interestingly, we're also seeing trade diversion. While direct US-China trade suffers, some trade is finding new routes. China, for instance, is likely redirecting exports towards other markets like the Euro area and the UK. However, indirect exports of Chinese products to the US, perhaps routed via third countries, are expected to be less affected than direct trade. There is even a potential impact on the energy transition. Trade tensions and any resulting economic slowdowns in China could affect its energy transition and climate policies. If China's economic stimulus measures prioritize traditional industry over consumption and services, it could unfortunately lead to a rise in greenhouse gas emissions. So what's the outlook? The recent 90-day tariff reduction agreement is definitely seen as a positive step. It's a move towards de-escalating trade tensions and has provided some relief to the markets. We expect to see a short-term rebound in Chinese exports to the US, as importers rush to replenish their inventories during this window. However, uncertainty remains incredibly high. That 30% US tariff on Chinese goods is still substantial. It will likely continue to encourage some level of trade diversion and supply chain adjustments. The real crux of the matter will be the success of the upcoming negotiations in resolving the core disagreements between the two nations. That will determine the long-term trajectory of US-China trade relations. Even with this recent de-escalation, the global trading system has been significantly disrupted. The trend towards protectionism and the reconfiguration of global value chains is likely to continue, at least to some extent. And US officials have mentioned a focus on non-tariff barriers, which indicates that the negotiations will likely delve into some very complex issues that go beyond simple tariff rates. The economic impacts of these international tariff agreements are multifaceted, affecting consumers, businesses, specific sectors, and overall economic growth, not just in the US and China, but globally. The situation is incredibly fluid, and the outcome of those ongoing negotiations is the key determinant of what future economic conditions will look like. It's a stark reminder of how interconnected our world is, and how decisions made in one corner can create waves everywhere. Thanks for tuning in to Fun Facts Online. Well, keep an eye on this developing story for you.